Okay. All right, we'll get started. I wanted to welcome you to the Homebuyers Webinar. I wanted to make sure that we keep this more interactive. So again, if you have any questions, either post it in the chat or the Q&A, which is somewhere on your screen, probably near the bottom. But the purpose of the the webinar, the workshop is simply to help explain a few things on preparing for home ownership. Of course, I'm Jim Campanella, and this is really not my first rodeo. Been doing this for just over 35 years. So my goal is to provide you some tools that can not only help you purchase a home, but prepare you for home ownership. Again, any questions along the way, just ask them, and let's have a little fun doing this. The basic agenda is the differences between renting and owning, the bonus to buying a home, the how to assess and plan to purchase a home. The aspects that go into purchasing a home is substantially more than just deciding to buy a house. There's emotional aspects to it, mental aspects, and financial aspects to it. We're going to recap the roadmap, which is what we more or less follow when we want to buy a home, and then spend some minutes talking about 2022, because it's certainly a different year already. We're 20 days into the year, and if you're not up on what's going on in the market, we'll talk about it at that point. So renting versus buying. When you purchase a home, I am not a tax person, but I can tell you that there are some potentially some tax advantages to owning a home. Your property taxes, mortgage interest, all may become deductible. But more importantly, that's a good reason to own a home. But more importantly, is there's plenty of statistics out there that show owning a home, owning your own place, creates stability for yourself, your family, and your children. Real estate being finite, meaning that there's only just so much real estate on the face of the planet, home values have always increased. Other than during the Great Depression and the Great Recession of 2008, nationally, we've never seen home values drop. Regionally, they certainly can, drop from time to time. It's happened in New England, it's California, and Texas during the oil collapse in the 70s. But on a national level, other than the recession and depression, they've never dropped, and we've never seen home values drop. So what goes into, the thought pattern of the thought process of purchasing a home? The first thing you need to really go through is the why. Why do you want to purchase a home versus rent? Do you want to are you planning on staying in the house for a few years, or long term? It helps make a decision on what type of property you want to purchase, as well as if it's feasible to purchase at this time. Will you be buying it with yourself, with a partner, with a spouse? You need to understand that this is a purchase is a big obligation, and you'd want to make certain that the person you're acquiring the property with, you want to acquire the property with, and make a commitment of that size. A home purchase is going to be probably your largest purchase in your life, so you want to make certain that you're prepared for that. Once you're confident that you want to buy a house, you need to look at the financial aspect of it and begin to think like a lender. This graph goes through the various steps of it, but I'm going to go off script a little bit here. Lenders look at the 4 C's, which is capacity, capital, collateral, and credit. Capacity is your ability to pay, or what we would call your debt ratio. Capital is your assets, the money you have in the bank. Collateral, of course, is the property you're purchasing. We're going to appraise it to determine the value of the collateral. And the credit is your ability to repay, or your history. So when you're making a decision that yes, now's the time to purchase a home, you want to understand your decision in the terms of the 4 C's. Now, well, starting with credit, you need to understand what makes up a credit score. 10% is new credit, 10% is the type of credit, 15% is the length of credit. That between the three of them, that adds up to 35%. Those three together only equal to what the other two by themselves stands for. So most of your credit score is based on the amounts you owe and your payment history. And when it says amounts you owe, it's not do you owe $1,000, but it's if you owe $1,000, how much credit do you have available to you? So if you have a credit card and it's a $1,000 available line of credit on your credit card, and you owe $1,000, that would be considered from a credit score standpoint a negative, because you're, for lack of a better word, abusing your credit. You're at your credit limits. You're going to get hit for that. Now, if you owe $1,000 and you have $10,000 available to you, it would view you as not a credit abuser. It would view you as somebody who's a conservative user of credit. And that's where that 30% falls in. So often, as lenders, loan officers, we look at how much, available credit you have to how much you owe to see if there's ways to improve your scores that way. Payment history is payment history. It's literally the history of how you've made your payments. The only cure for payment history is time. If you happen to have been delinquent, just let's make up a number, in 2021, last year, time is the only thing that's going to heal that wound to make that score go up. Unless, of course, it's an error. That's a different topic. But if you have, blemishes on your credit, time is the only thing that heals that one. Now, relating to that also, let's go back just for a second. Nowhere on here does it talk about credit inquiries. Everyone's concerned about credit inquiries. I'm not faulting anyone for that. But credit inquiries are sort of a necessary evil to the extent of, in order for us to determine if you're credit qualified, we got to pull your credit. Many people say, well, I don't want my credit pulled because it'll cause my credit to go down, and it could cause your credit to drop a little bit. That's true. However, it's something you really got to, address. And I'd be less concerned about whether you have an inquiry for a mortgage, which is going to get you the house, versus a delinquency or something like that. The focus should be on the rest of the aspects in your credit, not whether or not you have an inquiry. Credit score, real quickly. Credit goes for, anywhere from 350 to 850. I'm sorry. Anything at 740 or above is considered perfect credit. 680 to 739 is extremely good credit. 640 to 679 is, where a lot of programs fall into. And then below 639 from a lending standpoint would be considered, fair credit. That does not mean you can't get financing. FHA allows you to go to 580 credit score with 3.5% down, all the way down to 500 credit score with a larger down payment. VA, if in case you're a veteran, allows you to go to 500. So even though this is how we bracket credit scores, if you're below 639, it's not something to worry about. It just means that you'd be, we'd be in a different program. We would probably not go conventional. Well, we wouldn't go conventional. Now, there's 3 credit bureaus, national credit bureaus: TransUnion, Equifax, and Experian. Each one of the 3 have 16 different scoring models. So at this point in time, there's 48 different credit scores that you have. So if you happen to use Credit Karma or Credit Sesame and you get a score of 600 and we get a different score, that'd be the reason for it, because there's 48 different scoring methods. All lenders use the same scoring method. All banks, that lend for auto loans probably use, their own method for auto loans. Insurance companies use their own method for insurance companies. Everybody has their own method. That's how FICO makes their money, by coming up with all these different ways of calculating your score. But your consumer score, which you would get like on a Credit Karma or Credit Sesame will differ than what we get as a mortgage company, because we weight the credit differently. Where obviously, if you had a mortgage in your past, that's going to count more for us than not, because if you're able to make your mortgage payment in the past, you're probably going to make your mortgage payment in the future. So the credit scoring systems are different. There's 48 of them different. Just a quick tip, 1 out of 5 Americans, which is 20%, find errors on your credit report. So, that's one of the things that our current president and his administration has mentioned when he was elected that he would like to address. He may or may not, be able to do that during his term, but he wants to tighten up the credit reporting, because 20% of the reporting is incorrect. So that's not really something to be proud of. So, our president is hoping at some point to address that. He doesn't have any bills currently that I'm aware of on the table for it, but it is something that, has come up and they want to take a look at. But that's important to note, because, it's important to know what your credit report looks like and be able to address them in case there are mistakes. All right, soft pull. As I said, we focus on the credit inquiries because it has hits against us. Well, fortunately, there's another option. CrossCountry Mortgage is one of the lenders that's capable of pulling a soft pull. And what that means is if we can look at your credit without causing it to be an inquiry. Ultimately, when you do find a house, we do have to pull a hard pull, and we do have to pull your credit. But we don't have to do it to take a look at your credit and determine where you're at today and set you on a path. So this is a brand new product that we're able to offer. We're not the only one, I'm sure, that offers this, but it is newer for the industry to be able to do this. Again, ultimately, we are going to have to pull the credit, and it would be a hard pull, but you don't need to do that until such time that you're actually buying a house. So the soft credit pull option is now a way for you to say, hey, I would really want to know where we stand today and not have it affect you. And that's, as I said, that's within the last 30, 60 days we've had that option. So then, that's credit. It's important for yourself, because of course, as the lender, we're going to be looking at this too, for you to understand, what's called your monthly survival number. It's a budget. It's for you to know how much money you have coming in and how much money you have going out. If you've never actually taken the time to sit down and be honest with yourself and look at your expenses, it's a good thing to do. It's an outstanding thing to do, is to actually analyze, what monies you're spending. It's amazing when you do that, for you to see where some things are being spent. A lot of people, you see it in commercials and stuff. Some people have monthly expenses for Netflix and Hulu and Disney Plus and all those things. And they don't really realize they're not really using those services, and they're paying for it. Well, all those, $14.95s add up. So to make it consumer friendly, it's called your monthly survival number, but in all realistic terms, it's called your budget. And what that basically is you take a look at your income. Your income is your income, you know what that is. And then, list out all your expenses. Everything, look at your checkbook or your ATM withdrawals or your debit charges, calculate it down. So if you make $1,000 a month and you spend $500 on everything, at the end of the month, you should have $500 left. Now, what we recommend, this does not go into the underwriting. This is just for, what people recommend, is that you have 6-month cushion of your monthly survival number. So if at the end of the day, if you have $500 left, times 6 would be $3,000. So what it's basically saying is that's the type of cushion you'd like to have in the bank after paying your expenses. Now, after paying your expenses could also mean making your mortgage payment. This is not to prevent you from owning a house. This is just to help you understand your own budget. I just read something earlier today I don't remember what publication it was, but it was earlier today. 42%, it may have been something in ARP. 42% of Americans cannot cover a $400 emergency item today. So almost half of America doesn't have enough to cover a $400 bill. So that's what this is really geared for, is to start setting yourself in a mindset that, you know, maybe we can skip a Starbucks this week, or skip a Dunkin' Donuts or something, and start putting some cash away so that you do have the reserve. Again, from a lending standpoint, this does not necessarily affect you getting a mortgage by any means, but certainly we would feel better, you as a home buyer and us as a lender, knowing that we're not tapping you for every penny you have to purchase that home. So talking about that, we can talk about what your down payment and so on needs are. On a conventional loan, the minimum down payment is 3%. A government loan, it's 3.5%. And should you opt to go jumbo financing, which would be over 600,000, this has not been updated yet. January 2022, it went from 548 to 620 something, 640 something. So basically, you need, well, on a government loan, government includes VA. VA, should you be a veteran, is no money down. So anywhere from 0 to 3.5% is government, conventional is 3%, jumbos, 3.5 or higher. For down payment purposes, government loans allow for gifts to be given. So should you have an opportunity from a family member to get a gift for your down payment, that's allowed. Conventional allows for gifts also, but 5% of it has to be your own money. So if you're putting as little as 3% down, then it has to be your money. Okay, this is an area that becomes important to understand. Let's say you're buying a $100,000 house. I always use numbers I can work in my head. If you're going FHA, that's $3,500 down payment. That's exciting. You have the $3,500 saved, you're ready to go. But you have to hold off being ready to go, because there's also closing costs. When you purchase a home, there's cost involved in buying the house. You have to pay for an appraisal, you've got transfer taxes, you've got bank fees, you've got title insurance. It ranges anywhere from 2 to 5% above from the purchase price. So again, if you're buying a $100,000 house, you've got to really count for, maybe another $3,000 to $3,500 in closing costs. Now there's ways to get around that by having your seller pay those costs, and by working with a professional realtor, you can get, they can work with you in negotiating, but those costs still exist no matter who's paying it. And here's an example of those costs. Should you decide to go with a home inspection, which we'll talk about later, it's going to be anywhere from $300 to $1,000, depending on the size of the house, so on and so forth. Appraisals don't even count on the $350 anymore. The world has changed. It's $550 or higher. $500 to $550 is what appraisal is going to run you. Homeowners insurance, that's probably a pretty good range. You've got to pay the first year of your homeowners insurance up front, because you have to insure the house the day you buy it. Should you opt to use an attorney, that's roughly what attorney's fees are. I know in the Rockford area, very few people use attorneys. I don't necessarily understand why they don't, but they don't. I strongly recommend using an attorney. This is the biggest purchase of your life, but it's not required. You got lender fees, about $1,500, $1,000 to $1,500. You got title charges, and then you got the transfer tax in the state of Illinois. You pay $7.50 per every $1,000. So on a $100,000 purchase, you're going to be paying, $750 in transfer tax. So when you add it all up, it's going to add up to, $2,500 to $3,000 in addition to your $3,500 down payment. So again, tying it back to your money numbers, that's why we're looking or suggesting that you work out a budget where you have some reserves, because that's how the reserves get you to the position that you can pay for this stuff. And again, there's creative ways to cover this through having a good realtor. Your income. 2020 was a rough year for all of us, thanks to COVID. Many people were unemployed. Many people were laid off. Many people during the shutdown did not have any income. They had to rely on unemployment. It's good that the unemployment was available to us. However, unemployment is considered short-term income, and as lenders, we cannot count that. There are a couple exceptions, landscapers who get it every year or something like that, but basing it off of the 2020 COVID year, excuse me, unemployment, even though it may have helped you make it through the year, doesn't count as income. What we count as income is what you show on your W-2. So because of that, qualifying right now, although it's going to get better now that we're into 2022, but qualifying all through 2021 was harder than it has been for many years. And it's not because the guidelines have gotten tighter, it's because people's incomes were so messed up. So now that we're into 2022, shortly everybody will have their 2021 W-2s, and hopefully their 2021 W-2s bring them back to the levels that they were at, say 2019. Qualifying may become easier than what it was in 2021. But if you were looking at qualifying in 2021, you may have lost some of the excitement about buying a house because it was not an easy thing to do. Not that buying a house is ever an easy thing to do. We try to make it easy for you, but it is a big obligation that you're going into. But I think after the people start receiving their 2021 W-2s, it'll be easier to verify your income. Now, if if 2021 carried forward the same issues that 2020 had, and your income still remained low, well then, it's certainly worth trying. Why not? But it may cause you to look, for an additional year worth of income, because you've got to get your income back to the levels that you were accustomed to. We have to qualify you on the current years, even if they were really odd. Debt to income ratio. The guidelines, and I'm going to emphasize this strongly, is we base everything off your gross income. So if you make $1,000 a month gross income, the maximum debt ratio on an FHA file is 57%. So when you take in the house payment and your total debts, your total monthly debts, you can't exceed 57% of your income. So on $1,000 income, that's $570. That does not mean that you will be approved at 57%. What it does mean is that if you're at 58%, you won't be approved. But at 57%, that doesn't guarantee an approval. We look at the 4 C's, all the factors. We look at the credit, we look at the income, we look at the reserves, we look at all those things when we're determining it. But 57 is the drop dead number. If you had an 800 credit score, if you had $200,000 left in the bank, if you basically, were in the perfect situation, but you're at 58%, you'd be denied. 57, you probably would get an approval in that scenario. Housing front end ratio or housing payment ratio is 43%. Again, at 44%, you won't get approved. 43%, you may get approved. But the 2 ratios we look at is what does it cost for your house and what is your total obligations. Going quickly, another tip, of course, is keep your debt ratio as low as you can. Pay off what monthly debts you can. The example I use, and this comes up literally every month when I've got a customer there. Let's say you have a credit card that has a $200 or $1,000 balance, okay? And the payment though is $200 a month. Well, $1,000 is not a lot to owe, but at $200 a month, that's a lot of a payment. So it would be a recommendation to get your debt ratio down is to pay off that debt, the $1,000 debt, because we look at your monthly payment. So even though $1,000 isn't a lot, that's the total amount you owe. The $200 is a lot. So, that'd be a way to pay it down. So I know we've just got a couple more people joining us. I'll circle back here real quick for you guys just to let you know where we're at. What we talked about quickly before was the lenders look at the 4 C's. Capacity, which is your ability to pay; collateral, which is the property you're purchasing; the asset. Capacity, collateral, credit. Obviously, we look at people's credit reports, and the fourth one, which is your income and your qualifying ratios. So one of the things that we look at is your debt ratio, which is what we represented here. Is you want to reduce your debt ratio as much as possible. Now, again, if your debt ratio is out of line, that doesn't mean you can't buy a house. That just may mean you have to buy something less expensive so that we can get your debt ratio into line. When we take into account your, should you be looking at, let's use as an example, a condo, part of your housing payment, even though you don't pay your condo fee, your association fee to the mortgage company, it is a monthly obligation. So we do count your association fee as part of your reoccurring payments of your monthly debt. So again, if you guys have any questions, certainly just throw them in the Q&A, which is somewhere on your screen, or in the chat thing, and we can go through it, because I do want to keep it interactive. All right, so what makes up your house payment? You found a place, or you haven't found a place, but you want to get qualified for a loan. What do we take into your payment? Well, you take in your principal, which is the repayment over 30 years of the amount you borrow, the interest, which is how the banks make money, and then we have escrows. And what the escrows is really your money that we're collecting monthly on your behalf to make sure that your real estate taxes are paid and your homeowner's insurance is paid. So to make it simple to understand, let's say your real estate taxes are $1,200 a year, $1,200. If you take that, there's 12 months in a year. So we take 1,200 divided by 12 is 100 a month. So we're going to add to your payment, your principal and interest payment, $100 a month for your taxes. And when your taxes come due, we'll pay it for you. The reason banks do that, the reason lenders do that, is because a mortgage that we put against your house, that's our security, is in first position. The only thing that supersedes us is your taxes. So we always have to make sure your taxes are paid, because it supersedes us. If you don't pay your taxes, they could take the house and we lose our money. So we escrow your taxes, and the same thing with your homeowner's insurance. We always want to make sure your house is insured. You choose who you use for your homeowner's insurance, but we want to make sure it's paid, because if something happens to the house, it burns down and there's no insurance, it'd be very hard to collect the money you owe us on the mortgage. So we want to make sure that the tax and insurance are escrowed. And we do the same thing. We take your, whatever your, say your homeowner's insurance is $900 a year, 900 divided by 12 is 75. So we collect $75 a month to pay your homeowner's insurance. Now, if we don't have enough in escrow, and this is going a little further down the road, but if we don't have enough in escrow a year from now or 2 years from now, we'll still pay it on your behalf, but we'll have to adjust your payment to collect that money back. So when people say, oh my gosh, my payment went up, it's not that their more interest rate went up, or it's not that their payment went, it's their escrows went up. If you have a fixed rate loan, your principal and interest payment never changes, but your payment can, because your taxes and insurance changed. Now, if you put less than 20% down, you have what's called mortgage insurance, or PMI, or in the case of FHA, it's called MIP. And what that does is insures the lender the difference should you not make your payments, and insures the lender for the difference to get it down to the 20%. And you pay that. Everyone charges it. Like it or not, you're buying an insurance policy for the bank. But that's how it works if you don't put 20% down. Homeowners association dues, again, I briefly hit on, but if you have a condo or a townhouse, We don't collect that. You pay it directly to the association fee, but it goes into our calculation of what it takes to own that house every month, because you have to pay it every month, just not to us. Okay. A lot of people are curious, they've got their credit under control, the income is back, after the situation in 2020 with COVID, but they don't have the down payment. So there are DPAs, down payment assistance programs, that are available. I'm not going to spend a lot of time today on that, but we're going to spend a little bit of time. There's in Illinois, should you be buying in Illinois? If you're not buying in Illinois, every state has a program. They're just called differently, but they all pretty much, are structured the same way. We do a lot in Illinois. I also do in Wisconsin, Indiana. Well, I do all over the country, but let's talk about Illinois. In Illinois, we have IDA, Illinois Housing Development Authority. IDA currently has 4 programs. There are income restrictions on the programs, which means that you only can make up to a certain amount. If you make more than that, you may not qualify. The best program at the moment, and the programs, by the way, change from time to time depending on what funds are available from the government. So these are the programs available today. Previously, we've had other programs, and these programs at some point probably will change too. But the Opening Doors program is a $6,000 grant. You have to live in the house for 5 years, and the $6,000 is free. If you live less than 5 years in the house, or you refinance the house, you have to pay back your $6,000 on a prorated schedule. No interest on that $6,000, but you have to refund the $6,000. So if you use the $6,000 grant and you stay in the house for 5 years, it's literally free money. IDA Access has 3 parts to the program, whether you go forgivable, deferred, or repayable. Determines on how much money you can get. Under the repayable, you can get up to $10,000, but you pay it back every month over a 10-year period. No interest on that again, but you have to repay it. But it's 10 grand that up to 10 grand they give you. And we'll talk, a little more about IDA, or if you have any questions about IDA, I'd be happy to answer it. We do a lot of IDA. IDA has its place, and I'll hit on some of the reasons why it's not the greatest. It's a very good program, but I'll hit on some of the downside of it that people don't talk about. Your other program is a national program called Chenoa, the Chenoa Fund. And they have 2 programs available, more or less the same as IDA does, but it's a national program. Certainly can go into any state. Now let's talk about where the pitfalls of down payment programs are. As I mentioned earlier, FHA will allow you to go to a 580 credit score with as little as 3.5% down. It'll actually allow you to go to 500 with 10% down. So it gives you some flexibility because, if you're sitting at a 600 credit score or 590 credit score, you can actually own a house. Well, under the DPA programs, keep in mind the 4 C's that we talk about. You're taking one of the C's out. You're saying that, my down payment, my asset, is going to come from a grant from, the state. Nothing wrong with that. It's perfectly allowed. But if we're not using your asset, your own money, then we have to tighten up our guidelines because it's a riskier loan. You didn't put your, sweat and tears into this. You got the money from the government. So IDA, as well as Chenoa, as an example, requires a 640 credit score. You have to have a little tighter, a little better credit to qualify for these programs. And the reason for that is, again, it's a little riskier of a loan. If you have a 585 credit score, but you have your down payment, there's a really good chance you're going to do whatever it takes to make sure you pay your house payment. So if you take that out of it, that's the risk that's going involved. So with all down payment program, I'm not aware of any down payment. I'm not saying that there isn't, but I'm not aware of any down payment program in the country that doesn't require 640 credit score. IDA is 640 credit score. They also have tighter underwriting guidelines. We had talked about earlier that you may be able to qualify up to a 57 debt ratio under IDA as well as Genoa. You only can go to 43% debt ratio. So the guidelines are tighter. Not a bad thing, but keep that in mind when you want to utilize a down payment program. They advertise how wonderful the program is, and it is, but there are restrictions to it. The other bigger restriction that I see, and I just want to mention it out there, as an IDA lender, we're authorized. Well, first of all, let's talk about all the down payment programs. When you're using a down payment program, they set the terms of the guideline. It's not our credit guidelines. We're not the ones making the rules. And as an IDA lender, we agree to their rules. So whether you come to me as your mortgage person, if you go to Bob's bank, if you go to Larry's mortgage company, we all have the same rule if we're offering IDA. Nobody can make an exception to it. It's their rules. So one of the guidelines that they have is, in order to, as part of the pricing of their loan, is they charge a 1% origination fee. What 1% origination fee, or 1 point, is 1% of the purchase price. So they're going to give you $6,000. They agree to that. We're going to give you $6,000. Congratulations. But we're going to charge you 1%. Well, if you're buying a $200,000 house, 1% is $2,000. So they gave you $6,000, but in order to get the $6,000, you got to pay $2,000 to get it. Yes, you're coming out ahead. You still get $4,000, but it's sort of deceptive, and that's just how the program works. Where the program is the strongest, in my opinion, is when you're buying something like in the Rockford area or down southern Illinois. If you buy something for $80,000, the fee is $800, 1%. That's a lot more realistic. IDA works for any level of homes. If you want to buy a house in Chicago and pay $300,000 for it, they'll give you $6,000, but they're going to charge you $3,000 to get the $6,000. My family comes from Sicily. We would call that, we'd call that some juice. So that's just something to keep in mind. It's not, we all have, it's again charged by IDA, so it's not charged by the lender. So nobody really, we don't run around talking about it because it's just what it is. But you need to keep that in mind, is that the $6,000 is the gross fee. We can do mortgages with no points. We cannot do IDA with no points. So you have to keep that in mind when you're trying to weigh in, because if you're saying, oh, the $6,000 is going to give me my down payment, well, it is, but it's going to cost you more to get that. But in any case, to answer the question in the Q&A, and thank you for asking, it's 640 credit score. 580 credit score for FHA, 3.5% down. But if you're going to use down payment assistance, it's 640. All right, a little bit about what we call the roadmap. And what the roadmap really is the steps involved and you'll see this in a couple seconds here as we go through the slides, but the steps that are recommended, and I use the word recommended strongly because when you see it, you'll understand. First, you need to understand who's who in your home buying process. You have a loan officer, somebody like myself, hopefully myself, but somebody like myself, who's going to, get you pre-approved and help you through the financing. You have a real estate agent, unless you're buying it from a family member, you have a real estate agent. Strongly recommend you talk to agents. I certainly know agents. I'm sure you guys know agents. You want to have somebody that's going to work with you, work for you. Today more than ever, because, and we're going to talk about this more so as we go along, but today more than ever, it's important to find an agent you feel comfortable with. And the reason for that is coming up. Appraiser. You don't hire the appraiser. We technically don't hire the appraiser. We hire an appraisal management company, an AMC. They hire the appraisal. In 2008, when the housing collapse came about, the government changed it. They took us out of the picture. They took you out of the picture. They don't want us involved, or you involved, or the seller involved with who the appraiser is. So this way we get a fair value on the appraisal. But appraiser is going to be part of the team. Attorney, again, most people use attorneys. In some states it's required. Illinois does not require it. If you're up in the Rockford area, you know Illinois doesn't require it because very few people in Rockford use an attorney. I still strongly recommend using an attorney, but you don't have to. There's no law in Illinois that says you have to. But if you do use an attorney, they're on your team. Title company clears the title to the house because obviously you want to make sure when you give somebody $100,000 that you own the house. That title company ensures that they do. Home inspector, not required by law in Illinois, but a lot of people get home inspections because you're buying this thing. It's yours. You want to make sure that what you're getting is what you expect. So he's going to be part of your team. And then of course your home insurance agent. If you don't have an agent, of course, I have ones you can recommend. But I would always suggest starting with whoever has your auto insurance. If you trust them to have your auto insurance, you probably can trust them to also insure your house. All right, so the steps involved, and this one's one of the ones that end up being sort of, although for my dear friend who's on here right now, she would agree that it may take 6 to 12 months discussions going through everything. But what they recommend is about 6 months to a year out, to have a conversation with your lender about getting pre-approved. Pre-approvals are good for 90 days. I'm not suggesting that you want to be 6 months to a year out, but it's not a bad thought. If you're really planning out buying your very first house, if you think about it, you may have been thinking about it for more than a year anyway. With the ability now for us to do a soft pull, and again, we only can do a soft pull for the pre-qual. Once you find a house, we do have to do a hard pull, but CrossCountry is one of the lenders that's allowed to do a soft pull. So if you want to know what your credit looks like today, we could find out without it dinging your credit. But what it's suggesting is, you start talking to your lender early. I can tell you, again, I've been doing this for more than 35 years. In the old days, the lender may not have been the first person you called. Now it's the first person you call. Before you look online for houses, before you talk to a realtor, you have to talk to your lender. And the reason for that is realtors won't even work with you unless you have a pre-approval. So you want to talk to, myself, somebody else, whomever, but you want to start with your lender. Pre-qualification versus pre-approval. Pre-qualification is basically, hey, how much do you make? Hey, how much are your expenses? We figure out the numbers, we run your credit. Hey, this is what you're qualified up to. It ain't worth the paper it's printed. It's a good starting point, but that's what it is it's a starting point. You really need a pre-approval. That's what you're looking for. And what a pre-approval is basically the same conversation. Hey, what's your income? But we back it up with, provide us your W-2s, provide us your pay stubs, so that we can really determine what your income is. Once we know what your real numbers are, we actually run it through what's called AUS, Automated Underwriter. If we get an approval, there's your pre-approval. It's legitimately an approval, subject to you going out and buying, getting a sales contract, getting an appraisal. If we have to liquidate something for your down payment, it'll be subject to things, but you'll know what your number is. Now, this is just a pet peeve of mine, maybe a few other people. A pre-approval really pre-approves you to a payment. Now, nobody understands that. I mean, well, am I pre-approved to buy a $100,000 house? That's what we all ask. I mean, and that's common. But a pre-approval really says that you're qualified for a $1,500 payment. The house you decide to buy has to fit into that $1,500 payment. So your pre-approval that says you're approved for $100,000 includes your taxes and insurance. Well, you might be approved for $110,000 if you find a house with less taxes, because that's all part of your payment. You might be pre-approved to $90,000 if you find a house with high taxes. And I mention that because we're in Illinois. And if you've looked at houses, and if you've looked at what their tax bills are, You could find houses literally on the same street with $4,000 a year in taxes and $8,000 a year in taxes. There's not many states like Illinois. I'm not picking on it. I've lived here all my life, but it's a mighty screwed up state. So you have, when a pre-approval, the pre-approval letter will say you're approved to 100 grand. But that, again, keep in mind, that's where you want to stay in contact, and the communication is important with your loan officer, because you could say, hey, look up this house, 123 Main Street. The taxes seem lower than the other one. Can I buy it for 120 grand? Well, you may be able to, and we can revise the pre-approval for that specific house. So just keep that in mind. It's a payment that you're pre-approved for. Again, the pre-approval letter, it won't say a payment. It'll say literally the 100,000. All right, again, the benefits of the pre-approval is you determine your budget. You're pre-approved for $1,500. Gives you greater buying power, which we'll talk about more again. By going to a seller and saying, look, I'm pre-approved for this amount, it's better than like pre-qualification, because again, that doesn't mean anything. Avoid setbacks. This one's huge. By starting with your lender early, let's say you have some credit blemishes in the past. Let's say maybe there's some income issues that we have to address. We can address all that before you end up under contract. Once you're under contract, you're going to buy your house in 30 to 60 days. Contracts right now running 30 to 45 days. You have a short window. That's a lot of pressure put on you. Trust me, it's a lot of pressure to say, okay, now I need you to do this, 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 and this. It just makes more sense to start doing those things ahead of time. So if we do need to address a credit problem, let's address it before you go under contract. Yes, I know you want to buy a house today, but let's get that addressed to, sooner than later, because that'll help relieve some of the stress, which we talked about, the mental side of things or the emotional side of things. Let's reduce that so that it could be a pleasant experience purchasing a home. And then it saves time too, because of course, if you've got yourself pre-approved, you don't have to be chasing those tax returns and everything later. So, it's a positive thing. And I see we're coming close on time. So, again, any questions, ask them along the way. Standard documents that we're going to need: 30 days of pay stubs, last 2 tax returns. Again, we talked about this briefly, with 2020 being so weird. We're thrilled to death we're now into 2022, because shortly we're going to have 2021 W-2s. Hopefully your 2021 W-2 is better than your 2020 W-2, because most of us had a very bad year in 2020. Assets, 2 months bank statements to show, that you have the down payment, copy of your photo ID, and then of course that we pull credit. So that's basically the information we need for pre-approval. It's also what we need for an approval. That's why it's a pre-approval, because we're documenting everything ahead of time. So, those are the things that you want to keep in mind. That's what we're going to be looking for as your lender, or as anybody's lender. Those are the things you're going to need. After you're pre-approved, go find a home. That's, go online, do whatever you need to do. You make an offer. You do that through your attorney or your realtor, or, if you happen to be doing it for sale by owner, you talk to the seller. Whatever you do, you make an offer, you come to terms on the process. In today's time, because of the short inventory, and some of you are probably aware, buying a home right now could take 3, 6, or even 12 months. You could make multiple contracts before yours gets accepted. It's not the way it's always been. I mean, again, I've been around doing this. This is the only thing I've ever done for a very long time, but it wasn't like that before. But right now, there's a shortage of inventory. And that shortage of inventory puts that the sellers are in control. You obviously prefer to be in a buyer's market than a seller's market when you're buying a house. We're in a seller's market. They control it right now. That doesn't mean you shouldn't buy a house. It's just be aware of it. If you've got your lease coming up March 1st of this year, be aware you might find a house, but you also may be renewing, because of the fact that it takes that long. I have clients right now that have been pre-approved multiple times, because again, a pre-approval is only good for 90 days. That's how long the credit report's good for. So I've had to, re-update it. But I've had clients that are a year out. They just can't win the bid on the right house. They find houses, they just, they keep getting outbid. But anyway, you make an offer, then you officially apply for a mortgage. Again, a pre-approval is exactly that. By terms of the definition of what the government has, is there's 6 pieces of information we need to be considered an application for a mortgage. One of the 6 pieces is an address. You have to be under contract. So even though you really technically, you applied for a mortgage when you went to the pre-approval process, we got all your information, but it's not technically an application until you're under contract. You have to have a contract saying, here's the address of the property I want to buy. That's when you're considered applying for a mortgage. And at that point, then we would have to pull credit, and it would be a hard hit. Prior to that, we could, CrossCountry can do a soft hit. Not all lenders can. We're not the only lender that can, but we are one of the few that are allowed or have that ability to pull a soft. Do's and don'ts of home buying, some of it should be obvious. If you're in the middle of buying a house, don't, and I just had this happen, don't go out and buy yourself a Tesla. It affects your ability to qualify, especially if you put a new car payment at $800 a month on your house or on your car. So, the don'ts are more important than the do's, but, if we just don't switch jobs in the middle process. If you have to switch jobs in the middle process, that doesn't mean your loan's turned down, but let us know that so we can re-qualify you with the new job. But if you want to quit your job and you can hold off till after the closing, that's probably better. Don't go co-signing for anyone during the process, because we're going to have to count that debt against you. We have no proof that person, you can say, well, yeah, I co-signed for my son and he's going to make the payments. Keyword, he's going to. You're obligated on the debt. We have to count it against you until you can show us 12 months history that he actually is paying it. So, these are the do's and don'ts. They're pretty self-explanatory, but often we run into the situation like last week with the Tesla. People get excited and forget that they're in the middle of buying a house. Underwriting and appraisal. After you've applied for the loan actually, we gather your information through the processor, somebody on my team, and it goes to underwriting. The underwriter goes through everything, verifies everything, may have a question or two along the way. We appraise the property, and then after it's ready to close, you go to closing. At closing, you're going to go to a title company. You're going to sit down. You're going to bring your down payment and your closing costs. You're going to sign a lot of papers. And an hour later, you're going to walk out with the keys to a brand new house. And it's going to be your house. And you're going to have the opportunity to make it your home. So that's basically the process. Again, 30 to 45 days after you're under contract is what it's averaging right now. If it goes a little longer, it may go to 60 depending on the circumstances, but most situations are 30 to 45 days. If you get yourself pre-approved, we actually could get you closed within 7 days. We don't suggest that. That's a stressful scenario, but you can. If you're already pre-approved and everything's done, all we have to do is wait for the appraisal and you can close. All right, going back, we had talked about home inspections and home appraisers. And this is something people get confused on. Even previous homeowners get confused on this. So I want to spend just a couple seconds on this. Home inspection determines the condition of the property you're buying. Not required in the state of Illinois at all. You do not have to have a home inspection by any means. You would order your home inspection once you're under contract. The contract would spell out that you have time to get a home inspection. The cost is roughly $250 to $400, maybe $500. I'm not a home inspector, but somewhere in that range. Your realtor, if you don't know a home inspector, would certainly have home inspectors he or she's worked with in the past to recommend to you. A home inspection is highly recommended because unless you come from a family of people who understand the inner workings of a house, you want to make sure that the furnace is working, that the roof is good, that the plumbing is good. Those are things the home inspector does for you. Again, it's at your cost and it's not required by the lender. Home appraisal is required by the lender, and the home appraiser is going to go out and determine the value of the house. They're not going to determine if the heater is working. They may turn on the heater to see if it is working and might mention that it isn't, but they're not warranting that it's working. They're just saying, you know what, you offered 100,000 for the house and it's worth 100,000. Congratulations. That's a home appraisal required by the lender. You pay for that, you know, at the time, once you're under contract, you pay for your appraisal. So between the two of them, again, going back to the conversation we had about down payments, if you're buying a $100,000 house, 3.5% down is $3,500. You need really more than $3,500 to buy a house, even though that's your down payment. Right here, you've got almost $1,000 in expenses if you want to get a home inspection and you have to get an appraisal. So you've got to keep that in mind, is that not to burst anyone's bubble because they've got their 3.5% down, but you need to have a little bit more than that. It's more important to be prepared than, you know, disappointed later. Breakdown of costs, we can go through that, and certainly I'm willing to, but basically their standard costs, what a recording fee is to record the mortgage, transfer taxes, the state of Illinois, all states do. But the state of Illinois charges $7.50 per thousand. Appraisal fees, again, escrow costs, we've talked about escrow. Prepaid items are nothing major, but your prepaid items are going to be like your homeowner's insurance. You got to pay that first year upfront. It's prepaid upfront, that type of stuff. And then origination fee, we briefly talked about, like with respect to IDA charges a 1% origination fee. All right, let's talk about 2022. What I did when I created this graph is I went back to 1985. That was the year I wrote my first mortgage, and pulled up the annual average mortgage rate for each year. So if you look at the graph, you could see we were somewhere around 16% or so when I started in the business as a rate. Rates dropped, then they spiked a little bit for about 3 years, and then ever since then they've been falling. So and the reason I point that out, and we just came off of all-time lows, historicals. I mean, the lowest rates have ever been. We bounced back now since then, but they're still extremely low, and that's the point I wanted to make. The average over, say, the last 30 years, a mortgage is 30 years long, so the average over the last 30 years, I think, was 7.6% average interest rate. We're well below that today. So even though we're not in the 2s anymore, you know, we're in the high 3s, maybe even the 4s, we're still well below the 30-year average. So that's the good news. I mean, it's not good that you're not going to get 2% or 2.5% or 2.9%, but it's still amazingly low. That's the good news. The point we need to make here, though, is we're in a rising market right now. So if you're working with a realtor or a loan officer or somebody who hasn't been around for a very long time, and I'm not faulting anyone who's not been around a long time, I'm just pointing it out. But if they haven't been around a long time, they may not know how to explain or how to address or even what to expect with the rates rising right now, because we're always used to rates coming down. Because as you can see graphically, they've always come down. Other than a couple bumps, they come down. We're not coming down, we're going up. The federal government's already announced we're going up this year. Unless something strange happens, we're probably going to go up 4 times this year, maybe more. Now, I will point out something strange happened in 2020, right before COVID hit. In January 2020, the prediction was the federal government was going to raise rates 3 times. Then COVID hit in March, and rates went to all-time lows. So there's always the exception that, you know, something happens that nobody predicted, because nobody predicted COVID, and we came up with the lowest rates ever. That was not planned. We were anticipating much higher rates, but we got the bonus of it for 2020 and 21, and actually into this year too. But rates have turned. Rates are going up. Since January 1st, or December 31st, the last 20 days, that's all we're talking is 20 days, rates are a 0.5 point higher than where they were at the end of last year. We've gone up a full 0.5 point in 20 days. It's the fastest rise in interest rates in a 20-day period. So if you're working with somebody who, you know, as a realtor or attorney or a loan officer who's not experienced in this, they're probably not going to know how to address this with you. But looking in the purple part of the graph, let's say you're approved for a payment of $1,500, because again, Even though it might say you're approved for $100,000, the reality is you're approved for a payment. So this is exactly what I'm talking about. You're approved for a payment of $1,500. At the beginning of the year, that was a $250,000 purchase. They're predicting that it's going to continue to, rates are going to continue to go up, which is going to reduce your buying power. So that's just something to keep in mind, because so far in the last 20 days, you've lost $5,000 per every $100,000 in buying power. So if you're buying a $200,000 house, or you thought you were pre-approved for a $200,000 house, you're today only approved for a $190,000 purchase. In 20 days, you lost $10,000 in buying power. And it's projected that we're going to continue on that pace for a little while. It may stabilize, well, it will stabilize. But right now, if you're pre-approved, if you've got a pre-approval letter that says I'm a pre-approved for 200 grand, well, guess what? You better talk to your loan officer, because you're pre-approved for 190. So that's to keep in mind. So what this is suggesting to you, how you planning to go into 2022, first you have to make sure you're emotionally ready to buy a house. Second, you have to make sure you're financially ready to buy a house. Of course, those are the big factors. It doesn't matter what interest rates are. But now what it does indicate is that if you are ready to buy a house, you probably want to do it sooner than later. Because later will mean that you're buying a less expensive house. That's not a bad thing, by the way, to buy a less expensive house. But if you have your heart set on, a $200,000 house, you're going to find that you're not going to be able to price yourself out to that level. 6 months from now, rates are anticipated to be, a lot higher than they are today. Again, we still are at all-time lows, and we're not going to get anywhere near the national average of historically. So it's still going to be a fantastic year, but they're not, because of the rapid increase in 20 days. You're going to have to restrict your buying power, and that's why it's important, where we talked about your team, to work with the right realtor, work with the right attorney, the right loan officer, a team that's going to A, protect you, B, have your best interest at heart, and C, know how to navigate through this. And again, everyone has to start somewhere. So I'm not faulting any new loan officer, not faulting any new realtor. I love new realtors. But they need to understand this is not the same scenario we were in last year or the year before. Or look at the graph for many years, and rates been dropping really historically for quite a long time. All right, any additional questions you might have, certainly put them in the question box, or everything I want to. We did run over, and I apologize for that. But put your questions out there. I'm happy. I'll hang around for a while to answer anything. I do want to throw this out here, though. If you want to receive some additional free material, which includes, I put together sheets on how to budget, because I think it's important, whether you buy a house, you don't buy a house, you use me as your lender or not. I think it's important that you understand your budget. So I put together ways to help you learn to budget. I put together some additional bonus material on your credit reports, and how to understand your credit reports, and who to contact on your credit reports. I put some additional information together on, as I said, how to understand the calculations of debt ratios and everything else, and then some sheets on home buying, tips and so on. All that stuff we'll mail to you. I don't want to. I can email it to you if you want it, but it's a lot to print, and I don't want to have to use your paper and your toner. So we'll actually mail it to you for free. But you got to email Erica, my assistant, with your name, mailing address, because obviously if you order us to mail it to you, I got to know where you live, and phone number, and we'll get that out this week for you. That's my little bonus to you guys, because again, going right back to what we said at the beginning, I am not here just to put you into a house. I really want to help you build a home. I want to help you. I've been doing it for 35 years. I want to see you successful. I don't want you, encumbered by bricks and mortar that you can't afford. So the goal here really is to help you become a successful homeowner. And with the bonus material, hopefully it'll help. Just again, just drop Erica a quick email, and she'll get that stuff out to you. And I really do appreciate you guys spending your evening with me. I hold these. We're going to do in 2022. We're going to do this every third Thursday of the month. So the next one will be February 18th. For January, February, and March, it'll be basically the same presentation. Obviously, it changes a little bit because things change, but it'll be basically the same presentation. Then the plan would become April, we'll do a different presentation, maybe on credit or something else. And then we'll do that for 3 months and another 3 months and so on. So there'll be 4 different presentations for the year, but it will be on every third Thursday of the month. So if you have, family, friends, coworkers, or anything that you think might benefit from this, have them sign up, and, happy to go through this with them. And I appreciate you guys' time. Again, I'll hang around for any questions you guys might have. Otherwise, enjoy the rest of your very, very, very cold evening.
I can't forget you, Campanella. You've been my hero from the start. I can't forget you, Campanella. You're still